Hi, this is Anthony with TradingETFs.com. Today is June 7th, 2020, and we wanted to just discuss an indicator here to talk about how much risk is in the market right now that many traders are not really focusing on. This indicator here is called the put-call ratio. And what that means is that it's a measurement of how many people are buying puts on the market, which means they're expecting the market to go down, versus how many calls are being bought, which is an indication of how many traders expect the market to keep going higher. And so let's just start off where we're at. Right now we're at 0.59, 0.59. That means that very few traders and investors are buying puts on the market, which means very few traders and investors are expecting the market to go down. Now, the reason we're bringing this up is if you look at the March time frame when the whole COVID situation started coming out and lockdown started to occur, you could see the put call ratio spiked all the way up to about 170. So what this meant is that in this time frame, many traders and investors were fearful that the market was going to go down, so they were buying puts expecting the market to go down. And obviously the market went down. Then when we fast forward to today, we're at 0.59. That means very few traders and investors are expecting the market to go lower. And so you have a situation of extremes. There was extreme fear back here, and now we're approaching extreme greed. And if you don't know what that means, is that when everybody is greedy, thinking that things are going to go to the moon, then that's the point where the market will reverse and move in the opposite direction. So going back to the March time frame, everybody was fearful that the world was coming to an end. They bought a bunch of puts expecting the market to decline. The market declined. Now we get to a point where no one is expecting the market to go down, and they've been buying calls. And so you have an extreme level here of traders and investors expecting the market to continue to go higher. And that's when reversals happen to the opposite side. So everybody was fearful. The market went down and then reversed. Now everybody is greedy. The market's gone up, and we could see a pretty sharp reversal. Now, the reason I'm highlighting this is that you have to be aware that even though trades are working out and money is being made on the market going higher, you still also have to look at what could go wrong. And right now, this low put-call ratio is a sign that things could go wrong quickly, meaning the market could reverse. So when we talked about taking a position in a certain trade, like for instance, let's switch it to the recent trade of sorry, I'm just pulling up the list here, taking me a second. I got to the wrong list. So when we talk about this trade here, the TBT trade we just entered in our Patreon account, we talked about how you want to control your downside, and you put a stop loss in here, let's say at 1630. That way, if the market reverses and prices go down instead, then you have a loss, but you get out with a controlled loss. So the reason we brought up risk is that you always have to be looking at what can go wrong with the trade. And so we highlighted here where a stop loss would be put in on TBT in the event the trade went the opposite direction. And so when it comes to this put-call ratio, again, we have to also be aware that at any given moment the market could reverse and the market could go to the opposite side, meaning the market could sell off dramatically, because again, everybody's on one side of the boat here thinking that the market's going to continue to go higher. And so it doesn't really give you a sell signal, doesn't really tell you in advance what level you should sell at, but it does say, hey, look, you got to be aware that there's risk in the market, and so that'll help you that you pay close attention to your open trades, so that if the market does reverse and starts moving down, then you can have that protection, or you can find a way to get out of the stock that you're in or the trade that you're in without getting too much damage. The worst thing to do is lose your money. You don't want to lose your money. So we just thought we would go over this because, again, a lot of people, I mean, it's great when you make great returns. Some of the trades that we've put on, you've made really good money on, and that's great. That's what we want to see. But you also have to be aware that things can reverse, and they can reverse very quickly. We do have a meeting this week with the Federal Reserve, and there's a lot of volatility that's going to come into the market. So that's why I'm highlighting it now, is that you give advance notice of, hey, there could be some more risk here. So if you're going to be away from your computer, your phone, and you don't have a stop loss in there, you need to really pay attention in case the market reverses on you. So that's about it. If you have any questions, let us know. Thanks for your time. Have a great rest of your day. Stay safe.